All right. First, let's start off at the high level. Would you mind telling us a little bit about Upfront?
Sure. So Upfront Ventures is as it sounds, venture capital fund. We're based in Los Angeles. We are actually not that new of a venture firm. We've been around for 25 years, if you can believe it. And we've been investing. We invest about 40 to 45% of our dollars in Southern California, from Santa Barbara to San Diego, but most of that is in Los Angeles, as you can imagine. But I like to tell people we're not a regional VC. So less than half our dollars go to LA, which means that the majority of our investing is outside of this region. We invest at the seed and A stage to give people perspective on what that means today, because I know these are moving targets as rounds and dollars seem to be going up. Our median first check, Mark, is $3.5 million.
Okay.
And so we're taking, well, I like to say we're not
And
stock
that's
pickers.
a weighted average with seed and Series A, or that's got to be more your Series A deals, yeah?
So median just being exactly as you would imagine from the statistics definition. We do equal number below, equal number above in terms of dollar size. But you'll find that most of our rounds are $3 to $4 million. We don't define them anymore. Let me tell you what I think's changed. How about if I just pose the first question and answer the first question? What's changed, Mark, about venture capital is that I used to be able to wait 9 months to kind of follow a company's trajectory and then do what I would consider to be an A round, which would be about $4 million. Now I have to make a decision really early on whether I want to go on a long-term journey with this entrepreneur. I'm still writing that same $3 to $4 million check. But the difference between me and a seed-only firm, because I would call that a seed check, the difference between me and a seed-only firm is that when you go to raise your next round, I will write another $4 million. So we'll end up around $7.5 to $8 million after your A round. But we are not stock pickers. So I'm not trying to do 50 to 100 different investments. We are company builders. So we join your board. We help you recruit team with pricing, communication, product strategy, and then hopefully attracting downstream capital.
Can I just clarify something in there before we move on? So you're talking about putting $3 to $4 million in the first investment and then the second, if you do the seed and the A. Do you continue to do more than pro rata in subsequent rounds? Are you a life cycle fund, or are you just at early stage? You'll do those first 2 rounds heavily and be very involved thereafter.
To be clear, we're a life cycle fund. So in our biggest deals, we have $65 million invested. So we also have growth funds. So we will lean in as your company becomes bigger. With respect to just being specific, we will either do less than pro rata, or super pro rata, depending on what the situation warrants. Sometimes we'd like to write more than pro rata, but that opportunity is not available to us. Sometimes it doesn't make sense. And sometimes companies, frankly, just aren't ready for their follow-on rounds. So what really is helpful about Upfront is if we're in for a penny, we're in for a pound. If we wrote the $3.5 million check, metaphorically, and if it's taking longer and we still believe in you and the product, we're willing to write the next check, whether the market is totally ready or not. We will do check sizes as small as $500,000 if the situation warrants. And our first ever, our biggest ever out of the gate, we wrote a $27 million check.
That's a huge first check.
Yes.
Was that a later round, or that was an early company that you felt needed a lot of capital?
It was a later round that is now a tremendously successful and growing business in the sustainability space. It's called Insect, like the word insect, but with a Y on the front. And what they do, Mark, just very briefly, is they use robotics and control systems to grow worms at industrial scale with the express intent of creating sustainable fish farms.
Very interesting. I love that.
So yeah, and it's now
doing well while you do good.
It's booked hundreds of millions of revenue now, and the company was started in France, and will hopefully, I think, very soon be in North America.
Wonderful. Okay, so let's touch on that for a second. Do you have a geographical focus? Is it mainly U.S., only U.S.? Was France an exception, or how does it fit?
So we do, as I mentioned, 40 to 45% of our investing in Southern California. We do about 25% of our dollars in the San Francisco Bay Area. So let's say we're about 60% California. I'd say we invest nationally. We have deals in Seattle and Chicago. We've invested in Baltimore, Las Vegas. We've invested in Texas, no problem. I'd say one additional unique thing about us is that we're very interested in cross-border between Europe and the United States. So the founder of Upfront, a colleague of mine, I've worked with him for 21 years, is Yves Sisteron. And as you might guess, he's from France. So we do a lot of cross-border with France. He's from Lyon. And he's still a full-time partner. I myself lived and worked in Europe for 11 years. So I've been doing cross-border with the UK. I have a partner who invests in video game sector. So he's done some cross-border with Finland. And we've been doing cross-border with Israel, and innovation around Israel overlapped to the United States for a long time as well.
That's great. So can you give us a rundown on the current assets under management? And that's AUM, if you hear that acronym, folks who are less familiar with venture going through this. How much money do you guys manage?
It's north of $2 billion.
Okay. And how much is in your active fund for early stage or growth? Are those pooled together, or do you have two separate vehicles?
We have two separate funds. We try to keep our A funds between $300 to $400 million. And then growth is just if it becomes appropriate. If we hit a growth stage, it allows us to lean into our winners with more capital, which we think is a benefit both to our LPs, the people who invest in our funds, and to entrepreneurs as they need more capital.
Right. How large is the growth fund?
Well, we have several growth funds. So we also have several hundreds of millions of dollars in growth funds. And that allows us, as I mentioned, to lean into winners, examples being Bird. So we've been a very active investor in every Bird round. If you look at Ring, the security doorbell company, we did the seed round. We did the seed round. We were in the very first round, but we did the A, the B, the C, the D, and the E round. We did the round right before Amazon bought them with our growth fund. We've been able to invest in GOAT, the sneakerhead platform. We were the seed round of GOAT, but we've been able to invest in all the rounds of GOAT, including in their growth rounds. So it allows us to follow the entrepreneurs from start to finish.
I love it. I love it. For the folks listening, for entrepreneurs and or LPs, you've touched on a little bit of this in terms of the hands-on operating support. Why should they choose Upfront? And maybe you can answer the question twice. First, for entrepreneurs.
Yeah. So if you're an entrepreneur, I think if you're looking for capital that gives you money and leaves you alone and just lets you get on with your job, we're probably not the best fit. We view, and I viewed this when I was an entrepreneur, as the best capital as being a sparring partner. Think of it as a coach in the stands who can see the whole field and in fact has the time, because we're not playing the game every day, to see multiple fields and therefore bring experiences to you. But like a coach in the stands, it has to be our perspective that you're the one on the field making the hard calls, because it's easy from the stands to think, oh, I know what to do, but really you only know what to do when you're on the field. So we like to be a strong sparring partner. And then we need to step back and say, you got to make the hard calls. I'm here to bring perspective, but to let you make the hard calls. And that's kind of how we view Upfront. So you should take us if you want someone super active in your side of the court.
How does that scale for you guys? As I think about the volume of deals you're doing, it feels like one of the ongoing constraints in venture is boards.
It doesn't scale.
Right? VC
we don't seek to scale. I just want to be clear. So I think there's two models that work in venture. And I'm not going to say one is superior to the others, but I want to describe the two models, Mark. Model one is I have a wide aperture. I want to do a lot of deals, and I don't necessarily want a super active role in each. Now, to be really good at that, you have to have a wide aperture, and you have to be really good at harvesting downstream investors from you. So if I'm a seed investor, I have to have really good respect and trust and relationship with A and B investors, because they will represent me on the board in effect, or they will be representing the interests of shareholders on the board. And so if I can attract great downstream investors, I don't have to play that active role, and I have a wide aperture. I probably don't own as much of the company. And frankly, I don't have quite the insights into how well is the company doing because I'm not there at board level doing the day-to-day. That's not the model we pursue, but I actually think it's a very successful model in venture. What we pursue is about 2 deals per partner per year. That's it. That's all we do. And so we're not scattergun. We're really looking for, I always tell people we look for 3 things. One is the perception of product market fit. I used to look for product market fit, but the true definition in my mind of product market fit is when customers are really pulling your product out of your hands and you're just filling orders. I can't invest at that stage because now that's the stage where people are giving you 50 or 100 million. So I have to believe that product market fit will come. And partly what we're analyzing is unit economics. Like, do we believe at a unit level, this is going to make fundamentally more sense than what exists in the market? The second thing I'm judging is founder market fit. Why are you doing this? Do you understand the industry better than we think almost anyone else we met? Do we have unique insights? Do you have unique insights into where things are heading? Because whatever the industry is doing today is not what it'll be doing tomorrow. But the third thing matters a lot to me, Mark, which is founder upfront fit. Are you the kind of entrepreneur that we want to go on a 10-year journey with? And are we the kind of investors you want to go on a 10-year journey with? Because we go into every situation expecting it to be a 10-year journey. And not everyone is like copacetic with how we work and vice versa. And that's okay. Like sometimes we're happy just to be friendly with people, but not be their investors. But those are the 3 things we look for.
So when you say 2 deals per year per partner, how many partners do you have?
7 investment partners, 7 full-time investment partners.
So you guys are doing 10 to 15 deals a year? Does that sound about right?
That's it.
Okay, great. Yeah, I think the construct you're describing was the one that's been around longer, the more traditional, do a couple of checks per partner, go deeper. I feel like the higher volume, less involved is more of a manifestation in the last 15, 20 years as capital requirements have come down. When I first started in the industry, the firm I was at was doing the same thing that you're describing. I think it's not uncommon for folks listening. Okay, very, very helpful. How do you manage, one of the things that's come up, I had Ian Sigalo on here recently, and we spent a little bit of time talking about their dynamic between their early stage fund and their growth fund, where there's different incentives. How many early stage deals does it take to move the needle for the growth team, right? It's a weird management dynamic as a VC. How do you think about the incentive alignment, getting all the parties to play together? Do you have different people managing the different vehicles? Is it the same people? How do you think about it?
It's a very good question. It's a question I've spent a lot of time thinking about, and it's a question I've spent a lot of time trying to inform LPs, my views. So here's how we do it. We have 7 full-time investment partners. We only do seed and A. We don't spend our time looking at growth deals. So we're seed and A investors in the end. I did not bring on a separate team to do growth, and I'm going to explain that to you in a second. One choice that some funds make is commingling into a single fund. Let's say it's a $700 million fund or $1 billion fund, and you do all your checks from the same fund. There's an inherent advantage to that, which is your LPs then are in every deal. That's great. That's fine. And everyone within your team and organization is incentivized and monetized in the same way. The downside to it is $1 million or $2 million or $3 million check don't move the needle. It's just really hard to kind of drive the kind of returns that you need. So what I see firms often doing there is they'll write $2 to $3 million checks really as options. And what they're really hoping is that eventually they cast wide enough a net that they can write a $50 or $75 million check because that's what they need to really move the needle. So it becomes an option.
That becomes the core business.
Factor. Yes.
Yeah.
And I don't flaw any of these firms, and I can't say that's the wrong model. It's not the model we chose. I care about the $3 million check. I care about a 5-person organization that has big dreams in its eyes and is building at the foundation. Of my first 4 investments, I sold one of them for $670 million. And we own just under 20% of it. One of them sadly went bankrupt. The other 2, which I did in 2009, I'm still on the board. They're still private. One is worth about $800 million. The other is worth about $650 million. And in each case, we own more than 25% of the company. Because I invested in the earliest round, I was on the board when it was an idea, not even customers and revenue. And I have invested in every round subsequent to that. And for me, that's what I mean. 10-year plus journey. That's now, what is that? 11-year journeys on those two different cases. So I just want to finish. I'm sorry, Mark, to be long-winded, but this one thought, which is, if you have a different growth team, that team truly is making independent decisions and looking for brand new deals to go out and hunt and do, which is good in its own right. But it may have some conflict with the A fund. They may have different objectives. We don't do that. Our growth fund, 70% of the dollars go to existing portfolio companies. So in our industry, it's often called an opportunity fund. We've chosen to call it,
right.
We've chosen to call it our early growth fund. So our goalposts are $100 million to $500 million valuations in existing companies in which somebody else leads the round and sets the price. I tend to write $10 to $15 million checks, maybe 20, into a round in which I'm the minority. So it might be 50, 75, $100 million, $200 million round, and I'm the minority of that round. We still do independent due diligence. We still have to underwrite the investment. We still have to decide whether or not we believe we still need to get a 5x return on that investment. So we don't do it in every company. But what it allows me to do is keep all 7 investors focused just on seed and A, which is what we want to do and which is what we're good at doing.
So you're an early stage firm who takes the opportunity to vig their upside with follow-on capital.
Exactly.
There's other firms out there which they'll have 2 business models, right? They'll have the early guys and they'll have the growth firm, and they're completely autonomous in what they're investing in. So for the folks listening, typical growth fund will invest in anything that it matches the stage. An opportunity fund is specifically focused on doing follow-on from an earlier fund.
And to be clear, we can do up to 30% of our investments in de novo new companies. And we will look. We just don't spend all our time focused on that activity.
Thank you. I think that gives people some helpful context about the firm, and I think that's a good baseline for informing the rest of our conversation. So thank you for going through all that.
Sure.